Hello, everybody. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns the Housing Market. Yeah, it's turning and churning. We have so much news going on. There's stuff happening every day in the marketplace, whether it's mortgage news, forbearance news, listing news, home price news, all sorts of stuff going on. Commentary, videos. There seems to be a lot happening in the housing market. I can tell you people are still drinking the Kool-Aid, or maybe they're still drinking, or they just started to drink it again, or made a new batch, whatever you want to call it. But either way, a lot of conflicting information, and I don't know whether people are just trying to believe their own propaganda to get them through what's going on right now. I'm Randy Patrick here. I'm putting the realism back in real estate. So as you can see, we got a little format going on here, something new. I'm trying some new software, doing some trials on some neat stuff these days, trying to improve your viewing experience and my viewing experience or creation experience as well too. Kind of interesting. So if you see me looking off to the side, I'm looking at another monitor and trying to make sure things are going okay. If you're already a subscriber, I thank you for your patronage. If you're not a subscriber, please go to the bottom right of the video and click the subscribe button, and we can take from there. All right. Thanks very much. So what we're going to do today is we're actually going to have a little bit of fun. So believe it or not, we're going to have some slideshows that we can sort of work through and support the channel. And again, this is sort of my first time doing this. This is kind of what I'm running on my Facebook Live stuff. I was sort of trialing the software there. Ultimately, I'll be doing a lot more of this and training stuff on the YouTube medium, but I got to start someplace. I got to work the bugs out. So listen, there's going to be mistakes. There's going to be issues. I know that there are people out there that will point them out to me. Trust me, I know what I have to do. It's all about trial and error, because what it looks like on this end doesn't always look that way on your end when you see it on YouTube. All right, so keep that in mind. All right, guys, let me get set up here. So really, oh, by the way, what's today? Today is Tuesday, May the 5th, which is Cinco de Mayo. So everybody celebrate that today. Hope you have a good time, have some drinks, have some great food, enjoy it in your social distancing today. All right. So a lot of stuff going on here. So this was actually kind of an interesting article. And really, it's all about Zillow. And Zillow is saying, hey, man, we're going to see some home price falling this year. So which is great. So they're admitting to it, which I think is wonderful, but only by about 4%. So I don't know about that, guys. I think that's a little bit light. So essentially, Zillow is sort of suggesting the fact that, we're going to see, medium view in terms of positivity, suggests that home prices will drop between 2 and 3% through the fourth quarter of 2020, and researchers expected home prices to recover through 2021. That's basically their researchers, their economists, their report, etc. Please don't take this as the gospel. All right. Realize that, Zillow is a company that needs to produce income. And it's got a lot of issues with respect to what's going to happen now. Well, it's got the homes they've bought on their Zillow offers sort of division. So you've bought offers, you placed offers, you bought property, and now there's potential of major losses there. We knew they were already losing on that business to begin with, but and that's with money, that's within a market that was appreciating. So now if we start seeing price drops and depreciation, it's going to hurt them a lot too. And don't forget, one of the things that you don't maybe realize if you're just a normal everyday person out there, but Zillow sells a lot of ad space to real estate agents. And one of the things that bothers a lot of agents like myself is the fact that they take your listing and they market your listing and they put somebody else's smiling face beside your listing. And guess what? Unless you want to buy space there yourself, you're losing out on your own products. You see, so which is kind of sad. But again, Zillow's forecast, though, they see what they do agree with is a decline in home sales. So they basically see a decline between 50 and 60% in home sales beginning of the year through April. And then basically, we're going to see it sort of pop up as the year goes on and everybody gets back to work, the economy opens up, whatever. So I'm not too sure whether this is accurate or not, but realize that this is sort of what they're predicting. I don't fall in that category. I believe that we will see at least double-digit declines, if not more. But realize, though, that what we're doing is we're sort of basing this against inventory. So in the last housing crisis, we had lots of inventory, and then we had lots of price declines that sort of helped bring the prices down. Now we have the decline opportunity, but we don't have the inventory to support that as of yet. So it's going to be a little push and pull, a little tug of war to see which which sort of end comes out on top. I still think it's going to be the price declines are going to win in the end, because let's face it, everyone's tapped out of, and it's tough doing real estate these days. It's tough getting mortgages, and it's going to get tougher, and credit's tightening right now. So we'll see what happens and how that plays out. All right. So this is interesting as well, too. This is one more Kool-Aid deal. So home flipping giant Opendoor says it's time to resume buying. All right. So guess what? Well, the company, they halted their purchases back in March. Opendoor laid off a third of their staff, and they're basically saying now, guess what? Excuse me. We have tons and tons of money that we have to put back into flipping houses. Let's go and let's do it right now. So basically, they're going to resume operations in Phoenix. So it has to be a place where a lot of was their ground zero, where they jumped on board and they deployed their strategy software and their marketing, etc. So that's what's going to go on there. I believe that reopen in Phoenix and test it out. They plans to reopen in more than 20 additional markets in the months ahead. So for me, what does this actually mean? So there's two things. They think that they can either buy and vulture on what's going on in the industry right now. People who have to sell or stuck, they might jump on board, taking advantage of some of the social distancing and some of the issues with respect to people not being able to show their homes and have open houses and stuff like that. So they're probably gambling on the fact that maybe they can buy cheap. And again, if they're in the Zillow mindset where they don't believe that home prices are going to decline very much, they think they can probably make a pretty decent profit on doing this. So that's kind of the scoop. So we'll see what happens here. I do think it's interesting. This is, they've got the cash and they've got the financial backing, just a matter of whether it's actually going to make sense or not, and whether they can get stuff at cheap prices and then sell them in the open market afterwards. So we'll see how that goes. All right. As I said, there's my Kool-Aid picture. So my comments or my thought process is, that's people are banking on maybe picking up some distress, but banking on the fact that we're going to have lower inventory still, which will keep prices at a higher level. So we'll have to see how that plays out. All right. In other news here, Wells Fargo is another lender who is pulling back with respect to what they're offering. So Wells Fargo is saying no to new HELOCs in the current market conditions. So for those of you that don't know, HELOC stands for a home equity line of credit. That's a HELOC. So basically, it's like a second mortgage, but it's not really a true second mortgage. It's more of a credit facility that you open up. It's a revolving credit facility you'd open up on your home. So you would go to Wells and say, hey, I've got all this equity here. I'd like to open a HELOC. They would do an appraisal, put you through the process and say, yeah, we can, open up, you've got, $200,000 worth of spare equity. We'll give you 100 or 150,000 of that equity, depending on your loan to value. And that allows you to make purchases. You can use the money, you can buy stuff. They don't care what you buy with it. What'll happen is you'll draw money out, and then it'll start its own little credit facility where every month you'll make minimum payments. And then, you buy whatever you do, you have more money, you pay it off. You have expenditures, you use it, type of thing. So it's like a revolving credit facility. So some people use it to improve their home. Some use it to buy houses and cars and whatever, thinking that their home will appreciate, and when they sell, they can pay that off. That's the risk factor. Going back in time, this was a number one thing. The previous housing crisis, the previous mortgage meltdown, I always tell you that subprime was sort of the initial starting point, but the true, we'll say, kicker, the stuff that actually really hurt the housing market and caused a lot of the crash was the fact that everyone was taking out cash out refis and HELOCs. They were equity stripping. So what we see now is we have lenders who are saying, you know what, we've seen this before. We're going to stop that right now. And they're not the first to do this. Obviously, I know JP Morgan Chase said a couple weeks ago they're going to pull off their HELOCs as well too. So it's just it's just part of the whole process here and of what's going on in the industry now. Just to what I guess you could say, tee this up again. So when we talk about potential defaults, delinquencies, foreclosure filings, foreclosure sales, short sales, REOs, whatever, there's always this kind of what I'm looking for. It's almost like an arm wrestle. So people are saying, are we going to have this? What's going on, et cetera? I don't know. So, when we have banks who are, number one, that they've already pulled back lending facilities. Okay, number two, they've already raised credit scores and they've tightened criteria, criteria meaning better verification, better documentation, higher down payment for customers to purchase properties. Well, also, so they know something's up. They can see it. They know what's going on behind the scenes, and they can plan for this stuff. So obviously, this article is a couple of weeks ago, but the point though is the fact that what they're saying is that like the largest bank here, J.P. Morgan Chase, is preparing for a massive round of defaults, whether it's in the the commercial lending sector, whether it's in the residential sector. They are basically ready to go, and they basically, they expect this. Now, two of the nation's biggest banks reported plummeting profits during the first 3 months of the year as they sought to prepare for an onslaught of defaults in debt that range from credit cards and mortgages to business loans. So the country's largest bank, J.P. Morgan Chase, said its profit fell by 69% as it set aside $8.2 billion, the largest amount since 2010, to prepare for defaults. So they're basically setting this profit aside to cover for the losses they expect. Wells Fargo's profits fell 89% for many of the same reasons. And again, what these guys are doing is they see what's going to happen, right? They've already seen the trend. So they know, we see stuff happening after the fact. They can see it sort of in advance. They can see slow payments, non-payments, stuff that doesn't even hit, our eyes in the marketplace before it really starts to unfold in the market. They can see the trends. And I know that I spoke about this probably a good maybe 6 months ago, that there was a lot of conferences going on, and basically like 80% of the banks, lenders, and servicing companies had planned on beefing up their loss mitigation, we'll call it back office, with staffing, technology, funding, whatever, starting for the last half of 2019, knowing that in the future there's going to be problems coming along. So they knew it was going to happen, maybe not quite this fast and this drastic, but a lot of the banks and servicers were already preparing for what they think would be defaults coming anyway. I think the virus just has, the virus has really sort of, tipped the scale over the edge, and now we're moving forward with this now. So just something to think about. All right. We have here what borrowers should know about skipping jumbo payments. So some of the stuff that we see right now about forbearance, is really, there's control, FHA, Ginnie Mae, HUD, they all have their rules and stuff like that. And there's a lot of confusion out there. So I know the lenders and services are trying to do their best to disseminate the information to make sure everybody understands what's going on. But one of the groups that isn't taken care of with respect to any of the, we'll call it, stimulus packages or loss mitigation packages or bailout packages, is we call the jumbo loan holders. So these are people who basically, have jumbo loans, like we're talking, hundreds of $1,000s worth of loans, $750 and above, that type of thing. They kind of, I guess you could say, think of themselves as the forgotten stepchildren of the pandemic. And the reason being that the CARES Act and stuff doesn't take care of this segment at all. All right. So what we have here is really, to me, it's kind of interesting. So this is where we're going to start seeing some stuff maybe happen sooner, because you've got some of the largest jumbo lenders, Chase, Wells Fargo, Bank of America, TD Bank, etc., are offering forbearance to their jumbo borrowers in 90-day chunks, waiving late fees and penalties related to forbearance and not reporting missed payments to credit bureaus, according to representatives from each bank. So basically what they're doing is the fact that they're doing it in these chunks. They're not actually offering, or they're not offering a year forbearance. And, basically borrowers can extend forbearance beyond 3 months if needed, but they basically, they want it paid pretty much right away. So some jumbo lenders are telling borrowers that the only option for repaying skip payments is to hand over when the lump sum ends. Most jumbo lenders have the leeway to arrange that arrears paid over the course of months or years, or in a deferral. It's one of those things that, deferrals can be done without going through a loan modification. However, we all know that as this kind of rolls through, that we may see, this group kind of get tagged with a lot of the foreclosure funds a lot quicker, because in the end, if you've got a jumbo loan and you've had a decrease in a loss of job, a major decrease in wages, are you going to have that money? You're going to have a hard time paying that large mortgage anyway, let alone distribution of payments over months, et cetera, et cetera. So it's going to be difficult. So really the jumbo mortgages are the ones that are the most exposed, because there's no protection at all for this. And the lenders know this, so they're going to try to figure it out. But in the end, I look at it going, you don't really have a lot of options here. They're going to try to work with you, but if things kind of play out, it's all going to boil down to you don't have the income when we put you through our forbearance or our loan modification sort of criteria process analysis to support this, and then we're going to have to take it down another path. That's what could happen, and that's what happened along the last housing crisis. All right, talking about forbearance requests. So clearly, we'll find out later this week about how last week, what the volumes were. So we had the last part of April. We also had the first day of May last week as well too. So we'll see how that works out here. But as you can see, for that we've got 5 weeks there from March all the way to last week of April. So each week the volume of forbearance requests climbed. We've got the total on the left, the non-depository lenders, and then the depository institutions on the right. So there you go. So we can just see that we're looking at over about 7.5% of all loans are in forbearance situations right now, and that could be increasing as time goes on. The expectations was 4 million or 4.2 million by the end of April, and obviously we'll see probably a kicker as May starts up as well too. So just to keep that in mind. All right. What else have I got here? So some locations or some groups are getting hurt more than other. Ginnie Mae mortgages. They've already got almost 10.5% of their mortgages that they back are in forbearance, and basically that's not a good sign. All right. So this is an MBA survey of about 56 servicers broken down by 31 independent mortgage bankers, 23 depositories, plus 2 sub-servicers. The respondents represent nearly 77% of outstanding first lien mortgages. So we figure the information is pretty accurate to see where it's going. So again, it's not slowing down. Yeah, it's going to slow down the amount of forbearance requests will slow down every week, and then the first of the month is high, then it slows down, then it pops up again. So we'll see these rolling waves of forbearance requests sort of popping through here. Okay, sort of to add on to that, we've basically got a lot of surveys going on. According to a survey from Freedom Debt Relief, 90% of Americans say their financial situation has been impacted by COVID-19 to some extent. Basically, 32% of participants say they have experienced a reduction in pay or work hours due to the virus. 65% say the pandemic relief check is not enough to get them through the current economy. There you go. 45% report that they are already struggling to make their rent or mortgage payments. So that's why when we hear back to work and everything's going to be great, it's a blip in the radar here, everything will be good. Well, it's not going to happen like that. So people are getting hurt, more than we believe. Yes, some states right now, Florida, where I live, as well as one of them, are going through some sort of let's get back to business, let's get back to work, whatever. So, some places are opening up, some malls, some restaurants, they're having, I guess you could say, limited seating, certain capacity going on. But the problem is that all the people that lost their jobs or have had their wages cut, they're not coming back to work this week, working 40 hours a week and off they go, because all these businesses and locations and services are easing back into the real business world here, and they don't need all their staff. And so there's going to be carnage along the way. So if people think that everything's going to be great, that we're just going to start up like that, that's not going to happen. It'll be a rude awakening. It's going to take time to get us back to where we were. It's going to probably take a few months. By that time, the major damage has already been done. All right. 36% say they will likely miss their mortgage or rent payments for the next 6 months. So you got more, almost 40% of the respondents basically are saying we're not going to be able to pay, and we're going to miss payments, and we're going to miss mortgage, rent and mortgage. So that's not 5%, that's not 10%, that's almost 40%. That will have staggering implications for homeownership, for the foreclosure process, and for landlords with respect to rent collections and things like that. All right. So again, not looking too good. As we mentioned about the forbearance, because it's still on the screen here, that obviously forbearance requests have begun to slow, according to data from Black Knight Financial, but there's a risk of May-related forbearance activity changing that trajectory. So again, when we see things slowing down as the month goes on, where we are, it's the first month of this, so I don't think it's any cause for celebration whatsoever. When we see the second month, so this time, so the end of this week, we'll see May's date, the first week of May's or actually we'll see last week's data. So we'll see what happens. Then the week after, we'll see this week. So it'll be about a week to a week and a half before we can see the first full week of May's forbearance and mortgage data to see what happened. All right. So again, I look at it going, we're already surpassed 30 million in job, in job claims. That was a minimum prediction by Moody's, for with their economists, their analysts. So it's kind of like everything that people were saying up front is sort of happening right now. So it's not me saying this, it's what's going on in the industry right now. So again, just, we don't know what's going to happen. We don't know how much it's going to be with respect to all the reports and perspectives on the people who haven't filed yet or couldn't get through or delayed or overwhelmed. The systems can't help them. That's still going to, that's still people like they don't show up on the stats, but they're going to show up in the non-payments and stuff like that fairly soon. All right. Interesting thing right now, new home listings in April were nearly cut in half. So when we talk about what's going in the marketplace now, so basically stay-at-home orders increased the nation last month. It showed in the lack of home sales. New listings fell 44.1% in April, as well as asking prices flattening and homes staying on the market longer, according to a new report by Realtor.com. So there you go. So we're seeing a contraction in available inventory and activity in the, we'll call existing home sales world right now. So basically, when you take a look at new listings fell 44.1% in April, which I just mentioned. We take a look at the areas that were hit the hardest. The Northeast was hit the hardest by the pandemic and also saw the greatest decline in new listings by a whopping 59.4%. So almost 60% less listings going on right now, or less new listings coming on. The rest of the U.S. didn't stray too far off. The Midwest saw a 49.5% decline, a 44.1% decline in new listings in the West, and a 31.4% decline in the South. There you go. So basically, when you take a look at also the 50 largest U.S. metros and what's happening with them, so if Realtor.com, this 44% is across the board, across the countries, right? Now the Realtor.com took the 50 largest metros and saw that their inventory declined 16% year over year, with the biggest decline seen in the Milwaukee, Wisconsin metro, down 46%. The Philadelphia, Camden, Wilmington, Pennsylvania, New Jersey, Delaware, Maryland metro, down 38%. Providence, Rhode Island, Massachusetts area, down almost 30%, 29.3%. So that's where we saw, the biggest sort of, declines in, with respect to inventory. So pretty serious what's going on there. And, this is where we're stuck now. So we don't know, how much, what's the buying power going to be like? Everything's tightening up here. What's the appetite? How many homes are out there? We know that people have pulled listings off for various reasons. Why? Well, you don't want people in your house during the pandemic. You want to be safe. So maybe you figure there's less buyer traffic. And listen, there's only so much virtual showings that we can do out there with software, etc. So a lot of people decide to pull listings off, and therefore there's less traffic and lack of new listings, because why put it on to have it sit with days on market that no one's going to see it, and then you'll be forced to reduce price anyway. So you know what? It's kind of a roll the dice. We put your property in the market right now. All right. Now, good point here. Whoops. I actually forgot something here, so I'm going to keep reading this here. So why home prices are rising during the pandemic. I didn't put this up on the slide here, but basically they're saying demand obviously got a kick in the gut, but at the exact same time, so did the supply. It's really, I look at it going, the economy is shrinking, businesses are closing, and jobs disappearing due to the coronavirus impact, but the housing market prices keep chugging higher. This basically is a Wall Street Journal article. Home prices plunged during the last recession after a housing crash caused millions of families to lose their homes. Home values could start to erode again, especially when mortgage forbearances and some economists warn. We've also spoken about what's going to happen when these forbearance cycles end, and what's likely to happen to about at least half of the people who are applying for forbearance. We can basically say March hasn't. We haven't seen this so far. The median home price rose 8% year over year in March, according to the National Association of Realtors, while buyer demand has softened and sales fell almost 9% that month from the prior month. The supply of homes in the market is contracting even faster, recent preliminary data shows. So what the whole point is here is that some sellers are having a tough time because they believe their home isn't moving because buyers haven't viewed them in person or are reluctant to make offers right now, not because the asking price is too high, but they're waiting for stay-at-home orders to erase or to ease before deciding whether to lower the price. Now, that's from a seller's perspective. If I'm from a buyer's perspective, I'm certainly saying, you know what, I'm not going to pay that. I mean, because of what's going on, I'm going to make low offers because you can always raise your offer, right? Tough to place an offer and go, wait a second, I need to retract that offer. And, that's not going to work. So place lower offers, working your way up tends to work a little better. And you know what? There will be some insulting offers going on right now. And that's the way the market is. People are going to push the envelope. They're going to test the market, see what they can get. And they should, by all means. You should go out there. If you want to get a place, you need to buy a place now. Look at the inventory. Look at the price trends. See what you can do. Go low for offers. Work your way up. Ask for concessions, et cetera, et cetera. Do the best you can when purchasing a house. Real estate brokerage Redfin Corp said its measure of home buying demand, which tracks buyer inquiries, was down 15% in the week that ended April 26th, compared with before when the pandemic struck. All right. Mortgage applications for home purchases around the same time were down 20% from a year earlier, according to the Mortgage Bankers Association. So we know that people aren't going out to look at homes, whether it's existing homes or new home sales, et cetera. We know that. We'll just have to see how this plays out. At some point in time, homeowners are going to go, I need to sell. We don't really have a spring selling season anymore. I think that's kind of shot. We may have some, and what we might see is some fire sales because, hey, maybe, as cities and towns and counties and whatever open up a little bit more for business and transactions, you're still going to have people that have to move, that have to relocate before school starts for the kids and things like that. So we may see some months, maybe the June, July, or July, August months, where we got a lot of listings coming on, a lot of activity happening in a very short period of time because people have to jump on board and make those moves before school and things like that. So it's going to be a pretty wild summer. I think there's a lot going on. There's definitely, listen, there's different perspectives. I can tell you that there's an entire investment side of the house that talks about this, that basically says we're going to have declines in values. Prepare for it now. There's going to be defaults. There's going to be delinquencies. There's going to be great buying opportunities. Now is a great time to jump in and buy a home. Watch for it. Buy the best you can. Pick up something dirt cheap. And then you've got the Zillows of the world, the Opendoors, Realtor.com, all the other real estate agents, whatever, who are saying no. We don't see that happening. We say maybe a very marginal decrease in price because of the inventory issues, and we expect a brisk recovery. It'll be fast and we'll be back where we are. So again, who's drinking what Kool-Aid is what I always have to say, right? I look at it kind of like what happened last time through the last housing crisis. I know someone did make the comment going, why do I keep basing a lot of my expectations on the last housing crisis? Well, it's because we do have a baseline. We saw what happened before. So at least, we should, if you're smart, you would go back and look and see what happened and how did it play out, which I do all the time. As a matter of fact, I look at how it played out, and then I also analyze and look at how it can differ as time goes on. So there's a lot of wild cards that are going to happen that weren't present and not in operation back in the last housing crisis that will affect and maybe change some of the things as time goes on, and how the housing industry unfolds and sort of reloads after this pandemic here. So that's just something to keep in mind. But here's something for you which kind of almost proves that. So saw the Wall Street Journal. This is a couple of weeks ago, but I've been saving this one for the rainy day, of course. So real estate investors eye potential bonanza and distressed sales. So for me, one of my most biggest, we'll say, eye-opening or experiences or aha, you have that aha moment people talk about in housing, was what happened towards the back end of the housing market in the trough. Everything's peaked in July 2006, and we had our sort of X number of years going downwards, right? And then we sort of bottomed out in the trough, right around January 2012. So during the 2000, sort of maybe 10, 11, 12, 13, for me, it was the emergence of the real estate investment trusts, the corporate buyers, institutional buyers, the large buyers of property that they'll turn into rental property, et cetera. That was, to me, was the number one thing. So it was an interesting marketplace. They took up a lot of the inventory. It served a purpose. It helped spur the market on. It helped with the lack of inventory because they ate it all, helped increase, and they control the market. So essentially that helped increase price points to where they are today. Also, it did. The only benefit is offering residential rental to people who maybe lost their homes or need homes, etc., to live in. So it all worked out in the end. A lot of money was spent, and a lot of stuff went on. Our operations, we sold to 4 or 5 of these guys. We had lots of people a lot of homes that we did short sales. We moved to these hedge funds and these big investor buyers back in the day. But one of the things I want to point out is that this plays exactly into their hand. All right. This is what they want to see. This is what's going on. And that they're waiting for this to sort of unfold. Why? Because of the money that they have raised. So, this is a small article that talks about the volume of funds out there. So if you take a look, a group did this called Prequin, did this little analysis. So back in December 2008, there was about $94 billion kicking around waiting to be deployed by in the real estate sector from these funds, REITs, whatever you want to call them, however they're set up. Well, fast forward to where we are today, they believe there's about 142 billion they call in dry powder waiting to go. That's about a $50 billion increase from back in the last housing crisis. So that there's more players, there's more money, and that the single family residential class as an asset is a very sought after, I guess you could say, asset class to purchase because, again, if they're buying them off market, if they're buying them at the foreclosure auction, they're buying them cheap. They know that they can, they're going to buy them. They're going to hold them for, 10, 15, 20 years, whatever the number is. They're going to cash flow them. It's going to be great return for their investors. So this is what they're doing. So they're licking their chops, waiting for this to kind of fall apart. That's sort of been my thing, going forward, thinking, okay, how do we work around that, or how do we work with it and sort of, run both ends? That's my thought process, what I'd like to do personally. So anyway, just realize that, this article talks about all this money being generated and waiting there. So it's not like they have to go ask for it. It's there. They've got the cash. They've also got the funding commitments. So if they need to buy, they can draw upon lines, they can go after it, et cetera, et cetera. So that's just the way it goes. This is available. And, again, when we go back to the Kool-Aid concept where, you've got people trying to, talk in the industry saying everything's going to be okay. We're going to see nominal declines in prices. Everything's going to be cool. We'll get back up there. Again, you're talking to believe your own bull, and you'll make yourself feel better. You'll make the market feel better. You'll make your shareholders feel better, make your employees feel better. And then when we look behind the scenes, we got all these real estate investors and economists saying, absolutely not, it ain't going to happen that way. And then when you have this stuff, when you got 142 plus billion sitting in the wings, ready to pounce and take out more and more properties, I don't know. I think I'm going to bet on the side of where the money is waiting to go. That's where my thoughts are going to be. So that's the scoop. All right, guys. So having said that, that's it for today. So thank you for the views, the comments, the likes. Please share the video with your friends and family. If you're not already a subscriber, if you could please subscribe, that would be wonderful. And by the way, just a little self-promotion here. Lots of stuff on the go. I've got my training courses. I've also got my turnkey real estate stuff going on. And also I can do traditional real estate down here for people who need help finding homes or selling homes or want to invest, etc. Talk about short sales a whole bit. So please inquire. Basically, we've got my email up there. So copy that down and we'll go from there. So listen, I hope this worked out well. Again, I'm going to be trying some different software. So this is my first time on doing this to load up to YouTube. I'm going to be upgrading a lot of equipment here. I'm in the process of doing that, so we'll have some messing around. So again, listen, I'm not looking for you guys to critique me because I know there's always the people that say, oh, the bottom right of your screen is going to be fuzzy or whatever. Yeah, listen, it's lighting. It's a lot of stuff you got to figure out on your own. So I'm getting through that. But again, thought I'd change it up for a bit, see if you guys like it. If you don't like it, then I won't do it. If you like this, then maybe I could develop some more stuff this way and we could all have a better viewing and creative experience. All right, guys. Thank you once again. We'll look forward to speaking with you later on this week.